Roadshows officially launches our new AIM portfolio service, and I'm going to talk you through it. This is your menu for today. We're going to look at why you would want to invest in AIM, some of the fantastic opportunities that market presents. We'll look at the tax benefits of doing so. We're going to look at how we invest, that is how we pick stocks, and some examples of those. And finally look at the charges and minimums of this service. But we start by asking, why would you want to invest in AIM? AIM is the alternative investment market, part of the London Stock Exchange. It's been around for about 20 years. There's around about 800 companies listed, and it tends to be the smaller growth companies that you find there. So the pie chart here on the left breaks down the market capitalization of those companies. Most of them are sub 250 million, about a third are sub 10 million, so really tiny. But there's also about 20 or so which are FTSE 250 kind of size. It tends to be the smaller companies on AIM because there are far fewer listing requirements to join AIM, there's far lighter regulation, and so overall there's far lower cost. To give you an idea, it's about 3 times more expensive to list on the main market than it is to list on AIM. And this is a chart of the AIM market over the past 15 years, the black line, compared to the FTSE All-Share, the red line. And you look at that chart and you say, why on earth would you want to invest in this market? In the time that the FTSE All-Share has doubled, the AIM market has lost you 40%. However, there is an incredibly wide dispersion between the best and the worst companies on AIM. For example, this is the same chart. We've still got the FTSE All-Share as the red line, but instead of the whole AIM market, we've just got the AIM oil and gas subsector. Now, these are lottery tickets. They tend to be, on the main, highly speculative ventures that say, we've got a bit of land in Russia, we're going to go see if there's any oil underneath. Okay? It's huge riches or it's lose everything. And this is what this chart is really showing. So what I'm telling you, that within AIM, there is the good, the bad, and the ugly. AIM gets a really bad name because it's full of companies you wouldn't want to go anywhere near. It's full of the bad and the ugly. And ugly would be something like Quindel, if you followed that over the past couple of years. But actually, if you look hard enough, if you do your homework, and if you're very picky, you can find some really good investments. But you have to be picky. You have to order your Big Mac without the gherkin. So let's have a look at an example of a good company. Dart Group is about £900 million market cap, so it's one of the largest. That's kind of FTSE 250 size. Dart Group is the parent of Jet2, which is the budget airline and package tour holiday company. And Jet2 fly out mostly of the northern part of the UK, so the red dots on the map behind me. Leeds Bradford is its main airport hub, and Jet2 own 45 of their own aircraft and lease another 12, and they fly to all of these black dots across Europe. So it's all the high volume city breaks or the beach holidays. And this is what Dart Group have done with their revenues over the past 15 years. So we've gone from about 200 million to about 1.4 billion. Okay? This is a very well-run company that's growing very nicely. To give you an idea, Jet2's load factor, which is the number of seats filled as a percentage of those available, is 94%. Now that is industry leading. EasyJet would be 91%. It's a good business. What makes it an even better investment is you consider the financial health of the business. There's a net cash position on the balance sheet. The profitability, a 19% return on equity last year. But crucially, the valuation, 9 times earnings and a 7% free cash flow yield. So as I said, AIM gets a very bad name because of the bad and the ugly companies. But if you do your homework, if you know where to look, you can find some really good investments. And that is what this service is all about. Inheritance tax. Let's look at the tax benefits of investing in AIM, because if you have a portfolio of qualifying shares, they are then exempt from inheritance tax. So I'm just kind of a quick look at how those rules work. Starting with nil rate bands, which have become slightly more complicated since last summer, because there's now 2 of them. You still have your standard £325,000 nil rate band, but in addition there's now this main residence nil rate band. Okay? And there's certain rules applicable to this second one. It's going to be £175,000 by 2020-21. It's going to rise linearly until then. It can only be used against your main residence, hence the title, and that main residence must be left to your direct descendants. That's your children or your grandchildren. Okay? There's also tapered relief for very large estates. And this is where this £1 million figure comes from. Okay? Because both of these nil rate bands are transferable to a spouse, a couple that own a £1 million property would be able to pass that on without incurring any inheritance tax. On the other hand, the same couple that instead had £1 million in cash would only be able to utilise the £650,000. Above that would be subject to inheritance tax. So let's have a look at a chart. I always like a chart. This is your estate on death. You have the 2 nil rate bands that we just mentioned. Anything above that, above the purple line in the red bar, is then subject to inheritance tax. So when we come over here, the estate inherited has the 40% hole in the top. This is where an AIM portfolio fits in, because with business relief, we can raise that purple bar, we can get more of your assets where inheritance tax is not charged. In effect, all assets you can get that qualify for business relief save 40%. You save the 40% tax. So how do we get that business relief? Well, the assets must be unquoted, and for that purpose, AIM-listed companies are unquoted. But you need to be careful, because an AIM-listed company which has a dual listing on some overseas stock exchange would not be eligible. That would be considered quoted. And you need to hold those investments for 2 years. There are some very important exclusions. Importantly, we can't invest in investment companies or investment trusts, companies that exist to make investments themselves into securities or land or shares. And there's a few other rules here. So this is a really important part of our due diligence process. So we want to endeavour that every investment we make as part of this service qualifies for business relief and therefore will be inheritance tax exempt after 2-year ownership period. How do we make sure that they satisfy the rules? Well, it's about really understanding the business model, fully understanding the ins and outs of all the different parts. It's talking with the management teams, talking with the brokers, and reading the reports and the accounts. So now let's have a quick look at how we invest. How do we spot the good investment eggs from the bad investment eggs? If you learn nothing else from my presentation this morning, you can learn how to spot a fresh egg from a gone-off egg. And that is, if you put it in a glass of water and it floats, it's gone off. How do we spot good investment eggs? What we have done with this service is to replicate the very successful investment process that we have employed on our large cap, our main buy list of FTSE 350. And as an overview of our approach, we are snipers. We don't need armies of analysts looking at every single stock in the market, because our investment process is very targeted. So by that I mean we have a quantitative screen which will filter the market down to a far smaller subset. We can then focus all of our analytical attention on those companies that meet our criteria. And if you could explain our investment process in 2 words, it is trending value. if you look back over 50, 100 years of stock market returns and ask, what are the characteristics of outperformers, of long-term performers? We find that cheap stocks, which are going up, tend to do a lot better than expensive stocks, which are falling. And this is what this table here is really showing you. This is based on 50 years worth of S&P 500 returns. We segment the market left to right by a value metric, so price to earnings. So in column 1, these are all the most expensive companies, and in column 5 are the cheapest companies. We further segment the market top to bottom by momentum. So at the top would be companies that are falling, at the bottom, companies that are rising. The difference between cheap and rising and expensive and falling is 18.5% annualized return, or a 1.2% annualized return. So these are the characteristics of the companies that we want to invest in. Underneath the bonnet, how that all works, we have a quantitative screen. We can filter out a few of the stocks that we know are not going to qualify for business relief. And then we look across 6 different valuation metrics, which I've listed here. There's no good looking just at one metric. A company may look fantastic on a price to book, but terrible on other ones. So we look across these 6. We use enterprise value instead of market cap or price. That gives us a bias away from highly indebted companies, which is what we want anyway. We want quality companies. And then we have the momentum metric. So that initial stage of the process filters down the AIM market of over 800 companies into a far smaller subset. We then apply a huge amount of fundamental research, and this is by far the most important part of our investment process. Okay? So we want to really understand all of the companies that we would invest in. We're looking for the value creators. We're looking at the track record of management. But we're also focused on risk. We're looking at the weak balance sheets. What can go wrong? So again, this involves reading reports, reading industry reports, speaking to management teams, speaking to brokers, and really understanding these businesses. Now, this is a specialist service, so it is run within Hawksmoor by a specialist team. Myself, Jim, who you will hear from shortly, but we're also very fortunate to have the input of Chris, who has joined our Taunton office. Now, Chris has about 200 years worth of experience in institutional fund management for M&G and foreign colonial. He provides a very valuable governance and oversight function to this service. So what are we looking to do? We're looking for the golden eggs. We're looking for understandable business models, profitable, cash generative, in sound financial health, but with that undertone of trending value. Eligibility for business relief, exemption from inheritance tax is very important. It's core to this service. But in addition to that, we want to make sure that every investment we make stands up on its own merit regardless. So let's have a look at some examples of some good eggs. I think I slightly overdid my whole egg theme, but that's it. That's the last egg reference. So the next example, Robinson. Robinson is a packaging company, but it's at the niche, the specialist end of the spectrum. So rather than mass-produced generic bottles, it is the bespoke or the unique packaging for the major consumer goods brands. So whether it is Gillette shaving cream or Nescafe coffee, standing out on the supermarket shelves is really important to these brands, and this is what Robinson does. I've highlighted Robinson not only because I think it's a really good business, but also to highlight this is actually a really small business. It's only a £30 million market cap, and actually this is not the smallest one on our list. For most of our peers, the other AIM service providers, they wouldn't be able to go down this far. With significant assets under management, first of all, you wouldn't be able to get enough stock, and second of all, if you did, you'd end up owning half the company. So it's a virtue of Hawksmoor's smaller size that we can hunt where others cannot. But back to Robinson. Robinson has a very strong blue chip customer base. It's the Procter & Gamble, SC Johnson, the supermarkets, Reckitt Benckiser. To give you just a very simple, basic idea of what Robinson does. If you think of the Pringles packaging, Pringles, which for a very long time was Procter & Gamble brand, think of the plastic cap on top of a Pringles tube, which has been made specifically for that tube. It's been specifically made for Pringles so that it fits well and it stacks on the shelves. To create just that little plastic cap requires several £million of investment in tooling. Robinson have the 3D modelling, the prototyping, the know-how and the manufacturing flexibility to be able to do that. To give you an idea of the group, they've got 3 factories in the UK. 95% of what Robinson does is plastics. It's injection moulding, blow moulding, stretch blow moulding. Their biggest would be in Kirkby. That's for the food and drink market in the UK. They've got another one in Stanton Hill, which is more for cosmetics. So they'll have facilities for aerosols, this kind of thing. They've also got a rigid paperboard factory, which is number 4 on this chart, in Chesterfield. So if you think Marks and Spencer luxury chocolate boxes, probably the box was made in Chesterfield. But they've also got a few factories in Poland, that's serving continental Europe, and increasingly emerging Central and Eastern Europe. So it's a good little business. I mean, what they do is really quite simple. It's not particularly glamorous. They're not going to find the cure for aging. It's a simple thing, but they do it very well. It's really a business that's flown under the radar of most of the other big AIM providers. I think why it's a good investment, you look at the financial health, it's very conservatively managed, a 6% net cash to debt. It's very profitable, 9% net margin, but crucially on the valuation front, 15% free cash flow yield and a 1.3 times price to book. So this is what this service is all about. It's trying to find these really good investments that we want to hold for the long run, regardless of the tax benefits. My final example is Character Group. Character Group is the 4th largest toy company in the UK. So that's after Lego and Hasbro and Mattel. Character are behind the Peppa Pig toys, Scooby-Doo, Teletubbies, a number of the quite well-known brands. This, on your right here, this flowchart explains Character's business model. Character are involved in the dark blue shaded boxes. So typically, Character won't own the intellectual property rights to the brands. So in the case of Peppa Pig, that's owned by Entertainment One. Character licenses the right to create toys from Entertainment One. They design the toy concepts. Manufacturing is outsourced to a factory in China. Character have a team of people on location in China overseeing that, but they don't directly own the factories themselves. Character are then involved in the distribution, and that goes to the major retailers in the UK. So Argos would be their largest, around 20% of sales, but it's also the supermarkets, the Toys R Us, Smiths, that kind of thing. Character's strategy is very much brand driven. They are trying to nurture long-term brands with staying power rather than looking for the next fad, the next one-hit wonder. So the numbers in brackets give you their top 5 toys, number 1 being Peppa Pig. They're fairly well diversified across these 4 main categories of toys, but preschool is by far their most important segment. That's quite important because the preschool segment is less susceptible to the threat of the Xbox and the iPhone and the rise of other forms of digital entertainment. I mean, under 4s still like to play with toys. Teletubbies is an interesting one. Teletubbies has just been relaunched by the BBC. It was in November last year that it was relaunched by the BBC. CBeebies normally would have a 49% market share of the 0 to 3 year audience. When Teletubbies comes on, it goes up to 70%. Teletubbies is hugely, hugely popular, and it's going to be a huge winner for character this year. Let's put a little bit more colour to character, a little bit more meat on the bone. It's quite a small company. There's 180 members of staff. And this is a very asset-light business. They don't have the manufacturing facilities. That's all outsourced. Its staff are probably its most valuable asset. They are the designers, they're the thinkers, they're the guys that are bringing everything all together. Importantly then, average staff tenure is in excess of 15 years, which is not bad for a company that's been going for 25 years. Of the 5 executives in the business, 4 of them are the founders of the company. Equally important is the relationship with the IP owners. So in Entertainment One, which is the owner of Peppa Pig, they've had a relationship in excess of 10 years. It's a very well-regarded company in the industry. 1,000 hours of Christmas 2014 Peppa Pig TV adverts. I just thought that was interesting, that's why I put that there. Export is also really important to this business. So they are exporting into 20 countries worldwide, which is already 30% of sales. That's going to grow. So it's a good little business. It's very well run. What makes it a really good investment, again, is the financial health. We really like businesses with strong balance sheets. It gives them flexibility. It means that they're far better able to weather storms or shocks or the unexpected. It's very profitable, 10% net margin, and on the valuation, again, at 10 times earnings and a 15% free cash flow yield. Finally then, let's just have a quick look at the charges and the minimums, the other service detail. The annual management charge for this is 1.5% with a minimum of £500. That works out as a minimum investment of around £30,000. There is no initial fee, there is no exit fee, there is no dealing commission. There's just the £30 charge applied to each transaction. That puts us at the lower end of the market. And to illustrate that, I've compared Hawksmoor's fee structure to that of some of our peers. And without naming any by name, I have put a picture of an octopus here, a unicorn here, and a zebra here, if that gives you any hints. This is based on a £200,000 AIM portfolio in the first year. The green is the annual management charge, the black is the dealing, the red is the initial, and yellow is the VAT. And the difference is really quite large. It's actually £8,000 difference between us and the most expensive. I think a number of existing AIM providers say, well, we're giving your clients a 40% saving on their tax, so we're justified in charging huge fees. We don't think that's fair. We think we can do this on a far fairer fee structure. In summary then, to conclude, to bring everything together, what are we trying to do? The exemption from inheritance tax, eligibility for business relief is core to this service. That's what we're going to endeavour every investment will qualify. But in addition to that, we want to make sure every investment we make stands up on its own merits. That's really important. So we're looking for long-term growth. We're looking for excellent businesses at excellent prices. In addition to inheritance tax, this service can also be run within an ISA. There's no lock-in, there's no complex legal structures, there's no trusts to set up. If your client decides they do want to buy that yacht after all, they can change their mind. And we want to do all of this with a low cost and with a low minimum. Thank you for listening. That's all from me. Thank you.